Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So it always starts with an idea, one big entity or a lot of other people all trying to do something. So let's just say that somebody on some website, some media source somewhere says, buy AUM for whatever reason. They're bullish on AUM. You know, what then? Oh, so then AUM, what that means is that the Australian dollar is going to strengthen. So buy AUM calls. What would happen? Well, if everyone's trying to buy the 91 calls because someone's optimistic on Australian dollar, well, the market makers are going to see that many orders are all coming in at the same time. And as demand exceeds supply, assuming that the exchange rate is unchanged, the price is going to go up. Market professionals may decide to purchase other months, other strikes. They might even buy some puts against the exchange rate because they might go into the spot market, buy the Australian dollar in the spot market and buy some puts to hedge themselves. Why doesn't the marketplace, the market makers, continue to sell option prices at that same price? Well, because, again, when you talk about options, we're talking about expectations for volatility. They have a certain expectation for volatility. And at some point, when the market exceeds that, they don't just keep selling them. They actually think about hedging. So they'll actually try to do other things. They might even buy other options. So what's happening here? How does an order really affect the FX options prices? What is it doing? Well, what it's really doing is if a big order comes in, it's saying that volatility itself is going up. It's very important. Vol is going up. So the expectation for the exchange rate to move up a lot or down a lot is increased. So if that's the case, then call and put options are worth a bit more money. So what if this market maker sells 1,091 calls in a very short period of time? What are they going to do? Well, the answer is that depends, but more than likely, they're going to go and try to buy other options. They're going to try to buy some Australian spot. They might try to buy some futures. They're going to try to do a lot of things to hedge themselves. They might try, as I said, to buy some spot. They go into the spot market and they'll buy some put options at the ISC to hedge themselves because they're afraid of buying spot in case the spot market collapses. They need to have a hedge, so they buy some put options. Or they might try to buy further dated options. So if they're selling 1 month options, they might try to buy 2 month or 3 month options. Or they might even try to buy a lot of 96 calls to offset some of the loss that would occur on the 91 calls. The option Greeks are risk gauges for options. So every trade has risk unless a balancing trade is subsequently done. So the riskiest trades appear the safest. And remember, electronic market making has created very sophisticated option strategies and ways to monitor risk. But again, risk still remains. You can never, ever completely eliminate risk. And I think we saw that in 2008 and 2009. So if you look at the blue there on slide 59, you'll see that those were the old prices prior to the big hypothetical options order coming in. So when this big order comes in to buy, what happens? Both the calls and the puts all go up in value. So if you take a look at the bottom of that, this is assuming a 2-point increase in volatility. So what it's saying is that the 1 month option is going to move up about 31 cents, which means in the Greek world, 31 cents, assuming a 2 volatility point change, that means the Vega was about 15.5 cents. 15.5 times 2 is 31. So the Vega matters, and you might want to start thinking about that. Again, I'm going to be presenting a class on the Greeks on February 18th, so please come back and join me more for that one. But here, if you take a look at slide 59, you'll notice that the volatility is up and all the option prices are up. What could have happened, and I didn't build in the slide, but it's possible that all the prices were down because the implied volatility was lower, which just means when the implied volatility is lower, more sellers than buyers. If you have the implied volatility up, the less technical terms, not using the implied volatility, it's just more buyers create higher option prices, less buyers mean lower option prices. Volatility, the increased demand for the option affects the implied volatility. In this case, almost all the options rose in value with the underlying unchanged, creating greater demand, creating higher implied volatility. Conversely, if there was tremendous selling pressure, supply, the options prices would have been reduced. So we would have saw implied volatility fall. And again, you're going to want to come back to the class on options skew. Take a look at what live volatility, livevol.com. Go to their website, check it out. They have some really neat tools. If you're quote-unquote a non-professional, they have a certain rate for you. I think it's very reasonable. And if you want to watch these volatilities, go to livevol.com. Check it out. There's some neat stuff on volatility. At different prices, market professionals use slightly different pricing models, creating opportunities to trade. When prices are too high relative to your expectations, simply means there are more buyers and sellers. When prices are too low, again, relative to your expectations, simply means there are more sellers and buyers. Pricing differences are based on the aggregation of all market participants' future expectations for vol. Prominent market maker, these are a few quotes. One said, market making is like picking up nickels in front of a bulldozer. Another one said, the dilemma for market making is the realization of small profits often, while the potential for large losses are highly unlikely but not impossible. Black swan, think about this phrase of the black swan. By definition, it's an outlier. It's something we're not expecting. So nothing, when you think about a black swan, it says that you don't even think it could occur till it does. And then you make up an excuse and say, oh, that was something that was unexpected, and you call it a black swan. My point here is that when you're trading options, you need to think in terms of probabilities, expectations. Just because you're pretty certain that something's going to happen doesn't mean you should, quote unquote, create a huge position against it. I remember way back during the credit crisis, there was one big institution that made a huge prediction against the U.S. dollar because they said the trade deficit, the budget deficit were so great that the dollar was not worth anything. But you know what? The dollar rallied, and you all know this, rallied significantly against all the currencies in the world during that time. So it didn't really matter what the logic is that when you're trading options, sometimes everything defies anybody's expectations. And that's one of the benefits of the options market is that you have limited risk. So you might make a prediction that you thought the dollar was going to be worth less or worth more, but you could do it using options. And the options, when you buy them, you have limited risk. Even if you trade spreads, you have limited risk.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.